you desire wealth? Then you should just keep acquiring a variety of things that generate revenue. Unfortunately, although this advice appears straightforward, choosing which kind of assets to purchase that generate income is difficult. Most investors never venture beyond stocks and bonds when building an investment portfolio. This is because these two asset classes are well liked and have excellent possibilities for wealth accumulation. Stocks and bonds, however, are merely the top of the investment iceberg. Consider everything the investment world offers if you're serious about increasing your wealth. Today's video shows you all the assets that will generate a good cash flow for financial success. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Bonds. Bonds are essentially a debt you extend to a firm or a government. When you buy a bond, you'll know exactly how much money to expect back because they are relatively stable. To make up for carrying their debt for longer-term bonds typically have higher interest rates. However, depending on your individual investing aims and aspirations, you may decide to invest in bonds with various terms. You may select a few shorter period coins flowing properties and consequently choose shorter time period bonds set to mature within the coming few years. Depending on the bond and the present-day monetary climate, hobby charges vary. Usually bonds yield between 1 to 8%, relying on if you want to buy governmental debt, funding-grade company debt, or excessive yield, junk bonds. On the other hand, if you're seeking out one of the extra strong income-generating properties, bonds are probably a direction for you. Alternatively, you could keep away from investing in personal bonds and choose bond index funds, both as a mutual fund or exchange-traded fund. Peer-to-peer lending. A pretty new income-generating asset is peer-to-peer lending. With peer-to-peer lending, you and different creditors function as a financial institution to a person trying to borrow money. Similar to a financial institution loan, the borrower will pay back the major with interest. You're probably questioning why a person would not simply borrow at once from a financial institution. There are diverse motives for this. However, the borrower may have a low credit score in many cases. Borrowing from banks may consequently be very expensive. Equities or stocks. Stocks would undoubtedly be the best asset class of choice if we were to choose just one to rule them all. Stocks are fantastic because they are one of the most dependable ways to build money over the long term. Stocks reflect the equity, in other words, ownership, in a corporation. The fact that stocks doesn't need any continuing upkeep makes them an even better investment. While someone else, the management, manages the company for you, you own it and profit from it. Property rentals. Renting out assets appears easy enough as you need to buy a residence or condominium and rent out the rooms to tenants for a nominal fee. That does sound awesome. However, it's additionally a whole oversimplification. In fact, renting out assets is something however relaxing. That's because you're liable for all sides of the construction you're renting out. After all, you are the owner. That consists of repairs, maintenance, and chasing down tenants who don't pay you to hire. You can make cash from renting out properties. Many humans do. Fortunately, the popularity of sites means that you no longer need to worry about purchasing an apartment unit and can simply rent a spare room in your home. You need only register for the platform to benefit from short-term rentals. You'll be able to use the current real estate while still dealing with some of the inconveniences of property management. For example, a spare bedroom in your house. Certificate of deposit. Banks offer certificates of deposit, or CDs, as a low-risk financial investment. It's easy to understand how they work. You lend money to the bank for a set period, known as a term length, and you earn interest on the principal during that time. Term lengths can range from 3 months to 5 years. During this time, you will be unable to withdraw your funds without a penalty, but your money will almost certainly grow at a fixed rate. The interest rate is determined by how long you are willing to invest. However, the longer you lend money to the bank, the more you can earn. There are some drawbacks too, like inflation, low aggressiveness, and length of the investment. If you want a low-risk investment that will give you peace of mind, consider purchasing this asset. You might also want to know whether a CD or a Roth IRA is better for you. Private equity investing. The practice of investing in private companies, many of which are in their early stages of development, is called private equity investing. This can be an appealing opportunity, especially if you are in the midst of the next successful startup company. However, while private equity investing can yield high returns, several factors must be considered. The most obvious is that you will need to research to identify the best companies to invest in. Private companies frequently fail in their first few years, so exercise caution when looking for businesses to invest in. Private equity investing also has a lockup period. This refers to the period during which investors cannot access their invested funds. Depending on the company, lockup periods can range from 6 months to 10 years. When considering private equity investing, consider how a lockup period might affect your finances. Savings account. Savings debts are one of the maximum truthful belongings that generate passive profits. Opening a financial savings account at your nearby financial institution will permit you to earn sales from the hobby your personal cash accrues over time. The capability profits will vary depending on the account and hobby rate. Typically, traders can anticipate between 0.01 and 0.30% returned on the quantity positioned into the financial savings account. While low hobby prices may also bring about decreased returns compared to different profit-producing belongings, financial savings debts provide a liquidity advantage. Moreover, investors will frequently be capable of getting the right of entry to those price ranges on brief notice. Excessive yield financial savings debt also fluctuate barely from conventional financial savings debts due to their excessive hobby prices. However, they may frequently be the simplest at online banks, resulting in a few downsides. Investors may also be capable of uploading cash to the account through online transfers, and any aid troubles will frequently be treated online or over the smartphone in preference to in person. The trade-off between comfort and better hobby prices is something to recollect as marketers study financial savings account alternatives. Real estate investment trusts. If you want the concept of proudly owning actual property but hate coping with it yourself, then the Actual Property Funding Trust is probably right for you. A REIT is an enterprise that owns and manages actual property homes and can pay out the earnings from the one's homes to its owners. In fact, REITs are legally required to pay at least 90% of their taxable earnings as dividends to their shareholders. This requirement makes REITs one of the maximum dependable earnings-generating properties on the market. However, now no longer are all REITs the same. For example, residential REITs can create personal condo buildings, pupil housing, synthetic homes, single-owned circle of relative homes, and industrial REITs that can create personal workplace buildings, warehouses, retail spaces, and different industrial homes. In addition, REITs may be presented as publicly traded, private, or publicly non-traded. The publicly traded REITs are open to all investors and traded on a stock exchange like any other public corporation. Buying extra REITs is only necessary if you want to enhance your exposure to real estate, since anyone who holds a broad stock index fund already has some exposure to publicly traded REITs. You can purchase publicly traded REIT index funds rather than numerous individual publicly traded REITs. Private REITs are offered only to accredited investors, those with a net worth of at least $1 million or an annual income of at least $200,000 for the previous 3 years, and are not traded on a stock exchange. It needs a broker, which could lead to expensive fees, has fewer regulatory restrictions, and is less liquid due to the extended holding duration. Publicly non-traded REITs are offered to the general public, but not traded on a stock market. Greater governmental control than private REITs. It requires minimum financial commitments and is less liquid due to the extended holding duration. No matter how you invest in REITs, they often offer returns comparable to stocks or greater and have a slightly lower correlation, 0.5 to 0.7, when good times are good. However, publicly listed REITs typically experience a sell-off during stock market crashes, much like most other risky investments. As a result, owning them doesn't anticipate many diversification benefits on the downside. What do you think? Let us know in the comments below.